When we talk about energy or global markets, the image that comes to mind is almost always the same.
Oil.
It's always oil. You picture barrels of crude, the Persian Gulf, those big OPEC meetings in Vienna where everyone's just watching the price of Brent like a hawk.
Right. It's been the engine for, what, a century now?
Yeah.
So it makes sense that's where the focus is.
Exactly. But while the world has been fixated on oil, a massive shift, and I mean a truly seismic structural shift, has just happened in the nuclear energy sector.
Mm-hmm.
And frankly, unless you are a deep industry insider, you probably missed it entirely.
I would argue it's the single biggest structural change to the uranium market in 40 years, maybe even longer.
We're talking about Kazakhstan, which is, well, it's effectively crowning itself the OPEC of uranium.
That is not an exaggeration, not at all. Given their market share, you could say they're in an even stronger position today than OPEC is relative to oil.
So let's get everyone oriented. Today is January 18th, 2026. Happy New Year, by the way.
Happy New Year to you, too.
And we are watching the dust settle on some major legal changes that were signed just late last month, December 26th, 2025.
Right.
On the surface, it looks like a boring bureaucratic amendment. But you're telling me this is actually a geopolitical thriller disguised as paperwork.
It really is. This is all about control, it's about leverage, and ultimately it's the end of the era of cheap uranium.
So our mission for this deep dive is to unpack exactly how Kazakhstan is rewriting the script. We're going to look at this move from, say, friendly supplier to price maker.
And we have to talk about their value over volume strategy.
Yep.
It sounds great in a boardroom, but it's going to be very painful for utility companies in the West.
And the numbers. The production guidance for 2026 just dropped, and it is it's a shock to the system.
The math has fundamentally changed.
Okay, let's get into the weeds. We have to start with the rules of the game. Because as of December 26th, those rules just changed. The president signed the amended Subsoil Use Code.
Foundational document, yes.
Subsoil Use Code. It sounds incredibly dry.
It does.
Like something you'd read to cure insomnia. But you're saying this is the catalyst for everything.
It is the catalyst. Think of the Subsoil Use Code as a constitution for mining in the country. It says who owns what, who gets to dig, who gets the profits.
And the new amendments just ripped up that constitution.
They completely altered the relationship between the state and private companies.
Okay, let's role play this for a second.
No.
Let's say I'm a private explorer, a junior mining company from, I don't know, Canada. I raise some capital, I fly over, I want to find uranium. Under the old rules, what was the deal?
Well, historically, it was pretty straightforward. Classic risk-reward. You get an exploration license, you spend the millions drilling holes in the ground.
You take the risk.
You take all the risk. And if you hit a deposit, you generally had a clear legal path to mining it. That conversion from exploration to production was your reward.
Right, that's mining 101. I find the treasure, I get to dig it up.
Exactly. Or sell the map to someone bigger. But that link, that's been broken. Under the new code, private operators who discover uranium no longer get automatic production rights.
Wait, hold on. So I do all the work, I spend the millions, I find the deposit, and then what? The state just says thanks.
Here's the catch-22. If you find uranium and you want to extend your license to move toward production, you have to return those uranium-bearing areas to the state.
I have to give it back.
To get the extension, yes. And it gets even worse for the private sector. Kazatomprom, that's the state nuclear giant, now gets priority rights for all new exploration licenses.
So they can just circle the best spots on the map and say, mine.
That's essentially it.
Yeah.
They can reserve the best blocks for themselves before anyone else gets a look.
That's not just tilting the playing field. That's building a fence around it and locking the gate.
It creates a situation where the state has first refusal on everything. Yeah. But the real clincher, and this is the part that has analysts scrambling, is the new ownership structure.
I saw these percentages, 75% and 90%. Break that down for us.
So previously, you could have various joint ventures, right? A foreign company might own a big chunk. Not anymore. Any transfer of a new uranium subsoil agreement now requires Kazatomprom to hold at least 75% equity.
3/4. So the state is always the supermajority partner.
Minimum. But if you're talking about expanding or extending existing projects where a lot of the growth was meant to come from, the requirement generally jumps.
To what?
To Kazatomprom holding at least 90%.
90%. At that point, are you even a partner? You're basically just a silent investor with zero operational control.
You are a junior partner in the truest sense. You're there to provide capital, maybe some tech, but you are not running the show. No veto power. And analytically, this is staggering.
It's so.
This effectively consolidates over 20% of the entire world's mine supply under a single state-aligned decision maker.
20%. One boardroom in Astana is controlling a fifth of the global pie.
Exactly.
Yeah.
And it subordinates all the local junior miners. That old business model we talked about, finding a deposit and selling it to a big French or Chinese company for a huge payout,
Yeah.
that trade is dead. You can't just sell to the highest bidder anymore. The state dictates the terms.
It sounds like they're nationalizing the future potential of the sector, but without actually seizing existing assets.
Creeping nationalization is the term some analysts are using. It's legal, it's their sovereign right, but it completely changes the investment calculus.
Okay, so they've locked down control. Now let's talk about what they're doing with it. Usually the fear is a country like this will just flood the market with supply to get quick cash.
Right, the volume strategy. Pump as much as you can, sell it cheap. That's the old playbook.
But you titled this part of our notes, Value over Volume.
That is Kazatomprom's explicit strategy. They've realized they're sitting on the world's largest, lowest-cost reserves. They don't need to flood the market. In fact, it hurts them. They can make more money by selling less uranium at a higher price.
So they're turning off the taps.
They are tightening them. Which brings us to the numbers that just hit the market. The production guidance for 2026.
Okay, lay them on us. How big a cut are we talking?
The market was expecting, based on previous guidance production, of roughly 32,777 tons of uranium oxide for 2026. That was the number everyone had in their models.
About 33,000 tons.
Got it.
The new guidance. They cut it down to 29,697 tons.
That's a huge drop from the expectation.
In absolute terms, it's roughly 8 million pounds of uranium just removed from the market. And to put that in perspective for you, 8 million pounds is about 5% of the entire global primary supply. Gone.
5% of global supply wiped out. And this isn't happening in a market that's swimming in extra supply, is it? We aren't drowning in yellowcake.
Far from it. That's the critical context here. The market was already in a projected deficit.
Right.
You have demand from AI data centers,
Right.
reactor life extensions, new builds in China. The demand curve is steepening, and at that exact moment, the world's biggest supplier says, we're cutting 5%.
That is a bold move. It shows incredible confidence. It's a deliberate, operate below 100% strategy. They're signaling to the world that they will use volume restraint to support pricing. They are acting like a central bank for uranium.
And what about pricing? Where are we at right now?
Well, spot uranium has been in the low to mid $80 a pound, but the really important number is the long-term contract price.
What utilities pay to lock in supply for years?
Exactly, and that's been climbing from $80 to about $86 a pound through 2025.
So the trend was already up?
Yes, and this cut just acts like rocket fuel. It signals the end of uranium behaving like a fragmented mining commodity and the beginning of it acting like a semi-cartelized strategic resource.
Which brings us back to that OPEC comparison.
Precisely. OPEC cuts production to defend the price of oil. Kazatomprom is cutting production to defend the price of uranium. They're moving from price taker to price maker.
Okay, but this is where it gets really interesting. With rules this strict, like the 90% ownership rule, there's always a backdoor, right? There's always an exception.
There is an exception, but I wouldn't call it a loophole. It's a very specific and very expensive admission ticket.
So how can a foreign partner get a piece of the action without being watered down to just 10%?
Okay, so the new code includes what we're calling the Technology for Access Clause.
Technology for access sounds very transactional.
It is. The state will allow lower equity requirements, so they'll waive that 90% rule, maybe let you keep 25% if the partner agrees to two very specific demands.
And I'm guessing it's not just about money.
No, cash is easy. They want capabilities. First, the partner has to transfer proprietary technology for conversion and enrichment.
Okay, so let's clarify that for everyone. We're not just talking about digging rocks anymore.
Correct. Mining gets you ore, milling gets you yellowcake.
Right.
But you can't put yellowcake in a reactor. You have to convert it into a gas, UF6, and then enrich it in centrifuges. That is the high-tech, high-value part of the process.
And it's the part that's notoriously difficult to master. It's the whole reason we worry about nuclear proliferation.
Exactly. And Kazakhstan is saying, you want our rocks. You have to teach us how to make the fuel.
That is a huge ask. Companies guard that IP with their lives?
It is. And there's a second condition. The partner also has to build local fuel cycle facilities in Kazakhstan with guaranteed offtake.
Wow. So not only do you have to build the factory on their soil, on your dime, but you also have to promise to buy what it produces.
They want to move up the value chain. They're tired of just digging holes and selling raw material for $85. They want that midstream pricing power that comes from selling finished fuel rods.
I have to imagine there's a geopolitical angle here, too. Who usually does the conversion and enrichment for Kazakh uranium?
Historically, Russia. A huge amount of their material goes north to Rosatom facilities in Russia for processing.
Ah, and given the current state of the world, that's a liability?
A massive liability.
Right.
So by forcing Western or Asian partners to build this capacity inside Kazakhstan, they're trying to break their dependence on Russian services. It's a strategic sovereignty play.
So, putting this all together, strict new rules, massive supply cuts, demands for tech. Let's look at the winners and losers here.
It's definitely a matrix of pain and gain.
Let's start with the losers. Who is having a really bad day?
The utilities, specifically utilities outside of the CIS countries. So American utilities, the French, Japanese, South Koreans,
Why them?
they're the biggest losers because they got complacent. They relied on cheap, reliable Kazakh supply. Now they face higher prices and, more importantly, a security of supply panic.
Because if Kazakhstan decides to cut another 5% next year?
Exactly. They're realizing they're way too exposed to a single jurisdiction that's becoming more nationalistic. They now have to pay a security of supply premium.
Which brings us to the winners. If utilities need to diversify away from Kazakhstan, who do they run to?
Western and Asian miners. Miners in what we call Tier 1 jurisdictions.
Places like Canada and Australia.
Exactly. The Athabasca Basin in Canada, mines in Western Australia. This news is structurally bullish for them. Suddenly, a mine in Saskatchewan that seemed too expensive.
Looks a lot safer.
It looks a lot safer. The conversation changes from their production cost is $50 versus Kazakhstan at $20 to, at least I know the Canadian government isn't going to take 90% of my project.
So the risk premium on Kazakh volume makes Western projects more attractive.
It levels the playing field not by lowering costs in the West, but by raising the geopolitical cost of doing business in the East.
And what about the small, local Kazakh miners?
Their bargaining position is decimated. They exist at the pleasure of Kazatomprom. If they find something, they have one customer now, and that customer sets the price.
Okay, let's summarize this narrative. The old story of uranium was simple. Kazakhstan produces a lot and keeps prices low.
That chapter is closed. The new narrative is Kazakhstan as a rule-setting curator. They've moved from volume leader to strategic manager. They're exporting price discipline now, not optionality.
And you don't think this is just a short-term squeeze?
No. This is a multi-year structural repricing. You have legislated state control, deliberate underproduction from the lowest cost producer, and rising nuclear demand from AI and reactor extensions.
The perfect storm.
It is. We aren't going back to the old prices because the structure that allowed them to exist is legally gone.
A brave new world for nuclear fuel.
It certainly is.
Before we wrap, I want to leave our listeners with something to think about. We've talked about uranium, but usually when one country figures out a winning playbook, others start taking notes.
That is the question, isn't it? This is the Kazakh model. Assert state control, limit volume to support price, and force technology transfer.
Resource nationalism 2.0.
So if uranium is no longer behaving like a free market commodity, but a strategic state-controlled asset, how long until we see this elsewhere?
What if Indonesia does this with nickel? Or Chile with copper?
Or the lithium triangle in South America? If the value over volume strategy works for Kazakhstan, and it looks like it will, we should expect other resource-rich nations to stop just selling us their dirt and start demanding a much higher price for it.
A sobering thought for the global economy. We'll be keeping a very close eye on this. Thanks for joining us on this deep dive.
Thank you.
We'll see you next time.